As many of you have been reading in the news, central banks around the world have been raising their key interest rates in an aggressive manner to lower inflation. So let's have a look at the chart of the 5-year Government of Canada bond yield, which is the basis for 5-year fixed mortgage rates in Canada, to see what effect the recent increases by the Bank of Canada and the Federal Reserve have had on the yields and fixed rates. In this chart, we can see what happened to the yield over the past couple of months. Now, when it comes to government bonds, you have to remember that yields are controlled by investors. When investors sell the bonds, the yields rise, and when they buy them, they fall. Why investors buy government bonds is because they are one of the safest investments available and normally provide a rate of return which is higher than inflation. High inflation cuts into the profit of bondholders or possibly causes a loss. This causes a selling of bonds, which causes the yields to rise. So basically, when inflation goes up, bond yields go up as well, and fixed rates go up with them. So on June 1st, the Bank of Canada raised their key interest rate by 50 basis points, or 0.5%. Despite this commitment to the market that they were aggressively taking on inflation with the increase, the yield accelerated upwards. Now, this is strange. Why was this? Was the increase of 50 basis points not viewed as enough by investors? We'll circle back to this in a bit. Now, the U.S. Central Bank, the Federal Reserve, announced a hefty 75 basis point increase on June 15th, which caused a downward spike in the yields. This downward spike signals that investors were pleased with the large increase, which would be the result we would have anticipated when the Bank of Canada raised rates on June 1st. The reason the Fed decision had such a large impact on the Canadian yields is because the Canadian economy is so intertwined with the U.S. economy. Slowed U.S. spending reduces demand worldwide and brings down inflation. Now, aside from the rate increases by central banks, looking here at a very long-term chart of the 5-year yield, we can see that the yield has just reached a very important technical indicator for a reversal of direction. This indicator has to do with a previous high, and in this case, it's reaching the last large previous high, which was from early 2008. When a price, or a yield in this case, hits a previous high or low, it's a technical indicator that's used by traders and the computers that traders use to determine changes of direction. If the indicator shows that a change of direction is about to occur, investors will buy and sell because of this, and the very use of the indicator itself by investors causes the actual change of direction to occur. It becomes like a self-fulfilling prophecy. This may sound complicated, but you don't have to remember why this indicator works to understand that it does. Now, stock markets have been falling over the span of 2022. Normally, bond yields fall as stock markets fall because the stocks are sold and the money is then reinvested into bonds for their safety. Looking at this 2-year chart comparing the 5-year yield with the S&P 500, we see this happening in the past, but recently we've seen the opposite, which may be because inflation is too high for the bonds to be profitable. Regardless, although lesser amounts than expected, money still would be flowing from stocks to bonds despite high inflation, putting downward pressure on the yields. So we have downward pressure on the bond yields by money flowing from the stock markets to the bonds. A strong technical indicator used by traders has just occurred, and central banks are raising rates. But why again did the yield spike upwards right after the Bank of Canada raised their key interest rate, the opposite of what should have happened? On June 1st, OPEC, the Organization of Petroleum Exporting Countries, announced that they would only be raising output by a modest amount compared to what was largely deemed necessary to bring down oil prices, which soared as a result of the Russian invasion of Ukraine. So if you really want to know where fixed Canadian mortgage rates are headed, follow the price of oil. Just look at the correlation between oil and the yield in this chart. Rising oil prices increases the cost of shipping, farming, manufacturing, mining, lumber, and almost every business and industry on the planet. If the price of oil goes up, essentially the price of everything goes up, which is inflation, and is why the yields and the price of oil are so connected. A global concerted effort to bring down energy prices and make energy costs less volatile will do wonders to stabilize inflation. Now, we have, however, seen much less inflation than current levels when oil accelerated at these prices so quickly, which is because much of the current high inflation is the result of supply chain issues caused by COVID-19 measures. This is an anomaly caused by the pandemic that should ease over the next year. Overall, most economists expect inflation and interest rates to be lower in a year or two, making variable rates or very short-term fixed rates the best option at this time, compared with 5-year fixed rates or longer fixed rate terms. Thanks for watching, and if you have any questions, please leave them in the comments below or contact me directly through my website.